Hello guys, welcome to the video lecture on Introduction to Accounting. So our topic in today's video is relating to final accounts of a trading organization. Now let's understand why we do final accounts and what is the objective of doing a final account. Now final account will give us the profitability of a particular business, as well as it will provide us with information relating to the financial position of the business. Now while we do final accounts, we require to prepare trading account, profit and loss account, and a statement, and not an account, which is said to be a balance sheet. Now a balance sheet is basically assets and liabilities, and we try to estimate the excess of asset over liability, which represents the overall capital of the business. Now this capital will talk from the point of view of capital structure, which means to say the overall composition of capital. Now composition of capital means to say capital might consist of equity shareholders, preference shareholders, or equity shareholders. Whatever money the equity shareholder has contributed in the business is said to be the equity capital. Preference shareholder, if they have contributed money to the business, is said to be the preference capital. Plus there is also debenture. So that talks from the point of view of the total capital structure in an organization. So in a final account, the objective is to calculate the profitability of the business and to understand the financial position of the business, and we use trading profit and loss and balance sheet. And balance sheet is basically a summary of assets and liabilities to understand the financial position. It comprises of the asset part, which comprises of both fixed asset and current asset, and the liability part will consist of the capital and the other liabilities of the business. Now before we start on with the problem on final accounts, we require to understand what type of firm or business we are working with. Now the type of organization can be a manufacturing firm, or else it can be a trading firm. Now what I mean by the term manufacturing firm? Manufacturing firm refers to that the organization or the firm manufactures or is a producer of a particular product, as well as they do the trading part which they sell in the market. On the other side, there can be companies who doesn't manufacture, but they collect products or merchandise from various other manufacturers and they only do the trading part. So if the organization is only a trading company, then we term it as a trading firm. If the company is both a manufacturer as well as undergoing trading, then we term that as a manufacturing firm. Now why we require this information? We require this information because in case of a trading organization, we prepare trading, profit and loss, and a balance sheet. But in case of a manufacturing organization, we add one more account, which we say as manufacturing account, then we do trading account, profit and loss account, and finally summarize it via balance sheet. Now let's understand the output. So from a manufacturing account, what we calculate, we try to calculate the cost of production of a particular product or a material, which is to be transferred to trading account. The cost of production gets transferred to trading account, and from a trading account, we get either gross profit or else gross loss. So if your sales are higher compared to your trading cost or trading expenses, then you get gross profit, or else vice versa, that is your sales is less than your cost, you get a gross loss. And this gross profit or else gross loss we transfer to profit and loss account, and in profit and loss account we get net profit and net loss, taking into consideration all possible operating and non-operating income and operating and non-operating expenses. We get net profit or a net loss, which finally again transferred to balance sheet. And balance sheet, as we said, is a summary of assets and liabilities. Therefore, we get cost of production from manufacturing account to be transferred to trading account, where we get gross profit, gross loss. That particular thing is being transferred to profit and loss account. We get the output net profit or net loss to be transferred to balance sheet, which is a summary of assets and liabilities. Now before we go into details of the expenses or the cost items which are normally to be taken into consideration in final accounts, let's understand the major items to be taken into consideration in cost. We first start with raw material, where we include opening stock and purchase of raw material to calculate the overall direct material consumption, which means to say the raw material consumption. We also include direct labor and direct expenses. Now these three expenses, material, labor and direct expenses, comprising of prime cost. Then we add factory overhead. If we add factory overhead with prime cost, then we get works cost or else factory cost. Then we add office and administration overhead to get cost of production. Finally, we add selling and distribution overhead to get the cost of sales or total cost. So the major head here is raw material, direct labor, direct expenses, factory expenses, administrative overhead or office and administration expenses, and selling and distribution expenses. These all expenses are important because these are the major components which will be moving into final accounts. Let's understand which all thing moves into trading and profit and loss account. So the first and the elementary part, raw material, direct labor and direct expenses moves to trading account. These are the three major expenses which moves to trading account, whereas expenses relating to factory, office and administration, selling and distribution will move into profit and loss account. In addition, financial cost also moves to profit and loss account. So this is the major thing which you require to remember. Information relating to raw material, labor or wages, as well as direct expenses moves to trading account. Rest, like factory, selling and distribution, and office and administration overhead, together with financial cost, will move into profit and loss account. Let's understand the format of a trading account. Now, if you check the format of a trading account, it's typically a ledger account having two sides, debit and credit side. The debit side is the expense side. The credit side is basically the inflow side. So if we check the debit side, I said we take into consideration three important heads. One is with respect to raw material, labor and direct expenses. So we include here opening stock. We take purchase, we adjust the purchase return. We take wages, which is a part of labor. Carriage inward is basically a part of raw material. We take freight inward, cartage, which is basically a part of direct expenses. So we have taken basically raw material information, labor or wages, as well as direct expenses on the trading account debit side. On the credit side, since we are doing a trading account, on the credit side we take sales, subtracting the sales return, as well as we take closing stock. Now, if your credit side is more, that means sales and closing stock is more compared to the other expenses on the debit side, then we get a gross profit. Or else, if your expenses is more, that means to say the trading expenses are more compared to sales and closing stock, we get a gross loss. And this amount of gross profit or gross loss required to be transferred to profit and loss account. So this is typically a format of a trading account, a larger format, which includes information relating to raw materials, includes information relating to labor or wages, and various kinds of direct expenses which can be taken into consideration. Kindly note there are few factory expenses also mentioned here, but normally we will consider factory expenses or expenses relating to factory all in profit and loss account. So from a trading account, the output is either gross profit or gross loss, which required to be transferred to profit and loss account. Now in a profit and loss account, as we said before, we will be considering all factory expenses, office and administration expenses, selling and distribution expenses, as well as other financial cost. The debit side of a profit and loss account is the payment side, whereas the credit side is the receipt side. So first we require to transfer the amount of gross profit or else gross loss from the trading account to the profit and loss account. And as I said, on the debit side, we take into consideration all the expenses. So first, we require to take into consideration the factory expenses. Next, we have taken office and administration expenses, which includes salaries, rent, postage telegram, telephone charges, printing, office electricity. So all expenses which are related to office. The next part is selling and distribution, or is being said as marketing and selling expenses. That means any expenses relating to sales can be carriage outward, freight outward, salesman's salary, advertisement, go down rent, warehouse expenses, commission. So all type of selling expenses to be considered in selling and distribution overhead or marketing and selling expenses, and all type of financial expenses, be it bank charges, interest, depreciation, etc., will be considered under the head financial expenses. On the other side is the profit and loss account credit side, which I said is the receipt side. So anything which you have received, be it commission received, rent received, interest received, discount received, will be recorded on the credit side. So typically, we have recorded raw material, direct labor or wages and direct expenses in trading account, factory, office and administration, selling and distribution, and financial expenses and the types recorded in the profit and loss account. So finally, from the profit and loss account, we either get net profit or net loss. If my receipt is more than my payments, so I get net profit, or else if my payments are higher than receipt, then we get a net loss and required to be transferred to balance sheet. Now, what is a balance sheet? A balance sheet is basically a financial statement or a report from a company's side which includes information relating to assets, liabilities, and shareholders' equity. It provides a basis for computation of the rate of return and evaluating its capital structure. As I said before, capital structure is basically the composition of capital. So it can be money contributed by the equity shareholders as equity capital. It can be money contributed by the preference shareholders as preference capital. It also includes debentures. So this talks from the point of view of capital structure. So balance sheet displays the total assets of the organization together with all the liabilities, and also gives information as to this asset has been financed. Either has been financed from equity, that means the money which you have got from the equity shareholder, or else via debt, that means debenture or loan which you have taken from financial institution with which you have purchased certain assets. So it can also be referred as a statement of net worth or a statement of the financial position of the business. And the equation relating to balance sheet is asset is equal to liabilities plus equity. Now let's understand the format of balance sheet. So we have two sides. Kindly note, balance sheet is a statement and not an account. So we have a liability side and an asset side. Let's talk from the point of view of the asset side. There are certain major heads. First, we start with intangible asset like goodwill. Then we include fixed asset, then investment, current asset, and I further divided it into liquid asset. Now you're required to maintain it in the format. You have to start with intangible asset, then fixed asset, then investment, current asset, and liquid asset. On the other side, liability, we classify basically the two broad heads: fixed liability, current liability, capital, reserve, loan. The sequence has to be maintained, and thereafter you have the list of current liabilities. So this typically is a balance sheet. So from a trading account, we got gross profit or gross loss to be transferred to profit and loss account. From a profit and loss account, we got a net profit or net loss to be transferred to balance sheet. And finally, when you are doing a balance sheet, at the end, the balance sheet total, that means assets and liabilities, should tally. Now let's understand how a final account problem normally looks like. So this is a typical final account problem where you can see there is a trial balance given and certain adjustments given. Now please note, this trial balance entries to be recorded once, because the trial balance entries, because we are preparing a trial balance. When we are preparing a trial balance, we previously already have prepared journal and ledger. Followed by that, we have prepared a trial balance. Therefore, already one entry has been done. So therefore, you require to make one more entry. So trial balance entries to be recorded only once, either in trading or else in profit and loss or else in balance sheet. Adjustment entries need to be recorded twice. So it can either be in trading or profit and loss account, or trading balance sheet, or profit and loss balance sheet, depending on the nature of the expenses or information given. So trial balance entries to be recorded once, adjustment entries need to be recorded twice. So this is some basic information relating to what a final accounts is and the steps in which we require to do final accounts. We will be solving few assignments to understand the basic concept. I hope you have understood this particular video. Till then, thank you. Have a nice day.